Look, the oil market has largely rebalanced. Supply and demand have sort of broadly come into balance. We've seen inventories flatline, prices have rallied. All of that paints a relatively consistent picture. But if you dive within the data, you very much have to conclude that this rebalancing is supply-driven rather than demand-driven. Sure, demand is slowly coming back, but remains somewhat fragile. It's really the supply side that has adjusted very, very quickly and has driven this rebalancing. A lot of that supply side adjustment has come from OPEC. So if OPEC were to unwind these cuts, release more barrels to the market, we could very quickly end up back in a much more weaker situation. We know prices can go exceedingly low in that weak situation. So from that perspective, it is important that OPEC represents a relatively cohesive and united front. Quite often with these production agreements, if only one or two or three of the players start to deviate, then it has this habit of sort of falling apart altogether. So no, it is important that OPEC continues to exhibit a degree of cohesion.
OK, well, of course, the big concern for OPEC, Martin, as you know better than I do over the last few years, has been non-OPEC production and primarily US shale production as well. How quickly will that bounce back and how long will that last? Because, of course, you know far better than I do that there have been enormous investment questions about shale in 2021, even before COVID-19 hit the world as a pandemic as well. So, yes, shale can bounce back, but for how long?
Yeah, look, this is, if you say this is the billion-dollar question, that would even be understating it. I do remember from the previous oil price downturn in 2014, 2015, that many of the similar arguments were being made. And it seems entirely reasonable to expect, well, geez, the returns in US shale have been very disappointing. The markets, capital markets' willingness to lend or to provide equity to these companies should be somewhat impaired. Shouldn't that be a reasonable view? But it's also equally true that history shows that this is an incredibly tenacious industry, very inventive. This is an industry that really thrives when things get rather tough. And the resource base is rather large. The break-evens are rather low. I wouldn't bet against the US shale driller almost no matter what. So quite often it is said in the oil industry that the cure for low prices is low prices. And from a cyclical perspective, that is true. Low prices, less cash flow, less investment, and that impacts the supply side and then things rebalance. But it's also true that often low prices drive another round of cost deflation as companies squeeze out inefficiencies, squeeze the supply chain, optimize technical well design, those type of things. And when break-evens fall, then the industry can make it work at lower prices, and that there tends to be also a structural element to it. We think average break-evens of US shale are $40. So if you start to think an oil price bounce back to sort of 50, 55, you have an enormous spread between where the oil price then ends up and where the break-even of US shale is. And under those conditions, I would fully expect enthusiasm to fully return as it has done in the past.